I have decided to talk about this week's live training and focus on financing because I've been getting a lot of questions recently about various financing options, how to finance properties, what avenues are out there. And so because I've had such an influx in the amount of questions that I've been getting about financing, I decided that this week's live training would be focused on that. And at the same time, we are in the process of creating a brand new course all about financing options, financing avenues for buy and hold investors. And so we are right now kind of working on all things financing here at Rental Rookie. And I wanted to kind of give you a sneak peek and talk a little bit about financing on tonight's live training. We've been popping in here each week since the beginning of the year to do live training. Last week we missed because we had our Rental Rookie Pro Community Live Q&A call, and that was our first call that we had last month. So last week we didn't do our live training, but we're jumping right back in, getting right back on schedule, and bringing you practical, true strategies that we've used in our own investing journey, and kind of sharing that journey with you. So it's about 1 minute after 9. I'm going to go ahead and get started. As I go, if you have questions, comments, concerns, throw them in the chat box comment area, and I will get to them at some point throughout the training tonight. But let's go ahead and jump right in because I know that your time is valuable and I don't want to waste it. So tonight in our live training, we are going to be talking about and my goals for this live training is for you to learn some of the financing options and strategies for getting started with investing in rentals. There are tons of strategies that are out there. The 4 that I'm going to talk about tonight, by no means are they the only strategies or options or avenues out there for investing in rental property, but they are 4 that I've had a lot of questions about lately, and ones that I feel are, for the most part, pretty approachable for a newbie investor, since, a lot of times we're focusing on that, but also potentially avenues for people who are looking to grow if they have 1 or 2 properties. So again, these are not the only 4 that are out there. There are a lot more, and tonight I'm really going to focus on the high level aspects of these 4 types of financing options. So I'm really going to explain to you what these financing options are and why they could potentially be a good strategy for you. So tonight we're really going to be tapping into kind of the high level aspects of these 4 different types of financing options. We're going to be covering house hacking. We're going to be covering conventional financing. We're going to be covering seller financing, which I've had a lot of questions about lately, and also partnerships. So those are the 4 that we're going to dive into tonight on this training. And like I said, we are going to focus on the what and the why of those 4 different types of financing options in tonight's training. And like I said, there are a number of different options out there for you for when it comes to financing rental property. I'm just going to go over these 4 tonight. And again, the high level aspects of these 4 financing options. So let's go ahead and jump right into talking about house hacking. And if you've been around the real estate investing niche for any period of time or listened to other podcasts or blogs, I'm sure you've heard of house hacking. It's a pretty popular term that's thrown around in, I guess, the real estate investing language, if you want to think about it. It's funny that every kind of niche, no matter what it is, whether it's like kayaking or, climbing or, even in like volleyball or even just in these little sub-niche communities, they each have kind of their own language. And house hacking is definitely one of those terms that comes out of the real estate investing niche. And basically what it is when, and I'm going to break it down into a couple of different definitions, but one aspect of it is when you buy a property and you rent out a portion of it. So if you look at the picture that I have for you here on the screen, I have a picture of a duplex. You can see that there are 2 doors there. So this is a property that has 2 separate units in it. So one way you can house hack a property is if you buy a duplex and you live in one side of it, hence the U, and you rent out the other side of the property, right? The other unit. So that is one aspect of house hacking, right? You are living in the property, renting out the other unit. Another aspect of house hacking can also be related to if you buy a, let's say like a 3-bedroom, 2-bath house, you're single, you're just out of college and you buy it, and it's just a 1-unit property, so we're not looking at a multi-unit, and it's a 3-bedroom and it's just you, so you buy it and you are living in one, and you actually rent out the other 2 bedrooms to friends, colleagues, acquaintances. And so that's another way of going about house hacking, is even just renting out bedrooms in your property, right? It's your property. You can do what you want with it for the most part. And so another way of house hacking is to buy a property and to live in it and rent out the bedrooms. If you're catching already the, I guess, theme with this, it is the fact that you are living in the property, right? So with house hacking really comes down to the fact that in some way, shape, or form, you are living in that property. So in both of these first 2 examples, you're buying the property, right, as the buyer. You are planning to have the rent you collect from either the tenants, from any of the people who live either in the other unit or are renting bedrooms from you. That's going to help you pay your mortgage that you're going to have, because since you're buying the property right now, you are going to, and assuming whatever way you go about it, you're going to use financing, right? You're going to have a mortgage payment every month. And through doing this type of strategy, it's going to essentially lower your personal living expenses. So for instance, if if your mortgage is $800 a month, and by renting out your other unit or your other bedrooms, you're able to earn $800 a month, then you're going to break even, and at least your mortgage is covered. Right? The other pro to house hacking is that you are going to get to take advantage of the tax advantages that come with owning a property, right? Mortgage interest reduction, depreciation, those sorts of things. You, as the owner of the property, get to take advantage of that. The people who are renting from you do not. So that's another kind of, I guess, added benefit of house hacking. And then another way that you can look at house hacking is that it can also mean buying a property, living in it for a period of time, and then moving out eventually and turning it and keeping it. Instead of selling it, you actually turn it into a rental. Now, we actually did this with the very first little condo that we bought. I bought a 3-bedroom, 2-bath condo shortly before Kirk and I were married. That's where we lived for the first 5 years that we were married, and lived in Northern Virginia outside of Washington, D.C. And after 5 years, we, decided we were making the big move back to Pennsylvania, where I was from. And we kept that property for almost 2.5 years, and we had it as a rental. And so while we didn't collect rent while we lived in it, we were able to buy it with less money down. And that's one of the, I guess, biggest benefits that come with house hacking, because it is going to be an owner-occupied property. The availability for you to be able to buy it with a lower down payment is much better whenever you're going to be using financing from a traditional banking institution, right? So here, that's kind of the what is house hacking. If that makes sense, give me a like, give me a heart. Let me know that that is making sense for you. And the what, again, is essentially living in. It's related to living in the property for some period of time. All right, so why should you house hack? What are the benefits of house hacking? One, it allows you to buy a property with less money down. So you, because this is an owner-occupied home, could potentially even get in for as low as 3.5%, depending on what loan product you use. 3.5%, 5%, you can typically get into a property in FHA with an FHA loan product for that, versus the traditional 20% down that you would have to put down for a straight up investment property purchase through a loan product like a conventional loan. So definitely one of the reasons why a lot of people house hack is because of that lower down payment amount that you have to put in. Another pro or added benefit of why you should house hack is that you can potentially live in a house for free if you have other people living there or renting from you. So like our first 2 examples, if you have 2 units and you're renting out 1, or you have bedrooms that you're renting out, depending on how much you charge, you could potentially end up covering your entire mortgage payment, most of your mortgage payment, or maybe even be making money each month off of renting out the other unit or other bedrooms that are there in your property. I mentioned this earlier. Another added benefit is that you can take advantage of the tax benefits that come along with being somebody who is a homeowner. Again, you get to take advantage of those. You don't have to split that with the people who are renting from you. That is all your added benefit. And the other pro to house hacking and going about, in most cases when we look at house hacking, people are buying with most likely an FHA loan product. And when you go the FHA route, you're looking at lower limits for credit score. So if you don't have the greatest credit, there's still going to be some flexibility there for you. And higher DTI standing for debt to income ratios. That's where they're analyzing and looking at how much debt you have versus your income that you have. There are certain requirements for that whenever you're going to get financing from a banking institution, and there are higher DTI ratios allowed. So there's a little bit more flexibility with the loan products that are out there for you to house hack. So again, the what and the why of house hacking is that it is a property that you're going to live in for a certain period of time. And we just went over some of the whys as to what are the best, why it can be advantageous for you to house hack potentially your first rental property. All right, let's skip over and talk about conventional financing. This is a type of financing used when you are buying a true rental property. So this means that you will not be living in it at all, which is completely opposite from what we just talked about with the house hacking product and the house hacking avenue. You are buying this property with the sole intention of renting it out from the beginning. And as a result of that, there are some loan products that are out there that you won't be allowed to use because they are only for owner-occupied properties. So in this case, conventional financing is a loan product that you can use for a personal residence. So if you're going to buy a personal residence, you could use conventional financing, but it is one of the most popular, I would say, loan products for people who are going to buy pure investment properties. It's not part of any kind of government program, so it's not a FHA or VHDA or VA loan. It still has to adhere to some of the Fannie and Freddie guidelines. There are still some conforming things that it has to follow. And so while it's not insured by the government and backed by the government, it still has to adhere to Fannie and Freddie guidelines. One of the good things about conventional financing is that it can typically offer pretty good terms and interest rates. And the process of going about, if you've ever bought a property, you know that the mortgage process can be somewhat daunting and long and feeling like they're asking for every ounce of information out of you. And with conventional financing, it's a little bit more streamlined because it's not a government-backed, government-insured loan product program. There aren't as many government approvals. There just really isn't as much red tape that you have to jump through. And so that's why a lot of people prefer to go this route, although it does require the higher down payment. It's a trade-off. So why should you use conventional financing? Again, if you're not planning on living in the property at all, this is one of the best options when it comes to financing for a rental property. And again, one of the limited ones. You'll find that as you, start to go down this route, you start to talk to a certified mortgage planner, you will see that, there are certain loan products that are available for different types of purchases. So this is definitely one of the better loan products that's out there for financing a rental property. One of the caveats about conventional financing, one of the things that you need to know that's really important is it will require a higher down payment amount. Typically for a single family property, you're looking at 20%. If you're looking at the multi-units, you could be looking up to 25% when you use conventional financing, and it does have a little bit higher requirements for credit score. So like I said, with the house hacking and the FHA loans, you can typically get into those with a little bit less of a down payment. Conventional financing, you're going to have the higher down payment. FHA, you're going to have lower requirements for credit score and DTI. Those are going to be a little bit higher here with the conventional financing route. But again, it is not a government insured loan program. So a lot of that plays into, the fact that the government, if you were to default on an FHA loan, the government is going to back that and have to pay the banking institution for an FHA loan, where that might not be the case with conventional financing. So again, it is one of the better options. I can tell you just from our own investing experience, this is typically the loan product that Kirk and I use. We've used it on most of the properties that we've bought that we have used financing for, like traditional financing from an institution. And it's been, it's been a fine process for us to be able to use. So definitely a loan product that I, would recommend if you're looking to go the financing route. If it makes sense, let me know. Give me a plus, give me a heart. I want to make sure that this is all making sense. So give me a thumbs up or a heart if it is all still making sense. Okay, seller financing, the one that I have had a lot of questions about lately coming into the community, emails. So I wanted to make sure that I covered that tonight. So essentially the way to think about seller financing is that when you buy a property, when you go about the whole process of buying the property, you basically are going to negotiate loan terms with the seller. There is no bank involved in this deal, right? The reality is the seller really kind of becomes the bank, and that's kind of how you should look at them. You're going to negotiate interest rates with them. You'll negotiate down payment with them, the loan term, whether this is like over 5 years, 10 years, 15, 20, 30, you will negotiate that directly with the seller. So while that might sound a little intimidating, there's potentially a lot more flexibility there for you to be able to get terms that are maybe a little bit more advantageous for you than having to go to a bank and have to adhere to the government's rules and the banking institutions' rules and guidelines. Here you might find a little bit more flexibility. What essentially happens if you move forward is that the seller holds the note. You will write up a promissory note, and the seller will hold the note on the property, and you will actually pay the seller whatever down payment amount that you guys have decided upon, and you'll actually pay them your quote-unquote monthly mortgage payment, right? So the monthly payment that you would traditionally pay to a bank actually just goes to the seller, right? So again, there is no bank involved in this process. You're not having to deal with credit scores, potentially. You're not having to deal with DTI ratios, right? So some of those things are kind of thrown out the window when you're dealing with seller financing. It's all about really what you negotiate with the seller in terms of the terms. So, that's kind of the what behind seller financing. If that makes sense, give me a thumbs up, let me know. Why should you use seller financing? So why can this be advantageous? If you don't have a lot of money for a down payment, you might have more flexibility with the seller and terms than with a traditional lending institution, right? So if you don't have the 20% that you would need to put down, or maybe you can't seem to qualify for one of those, an FHA loan or conventional loan, you might be able to get potentially a lower down payment with using seller financing. If you haven't been able to qualify for a loan through a traditional institution, so we're looking, maybe you have bad credit, maybe you've had past bankruptcies or short sales, whatever that is, your DTI ratios, whatever that is that won't allow you to qualify through a traditional banking institution, this could be an option for you and still allow you to be able to go after and buy a rental property. Another reason, having the seller hold the note for you keeps your loan limit with financial institutions low. This is a big plus because you are allowed to hold multiple conventional loans in your name at a time. But once you hit the four conventional loans in your name, you're going to start to run into some issues. You can get up to 10 at this point, but it becomes, you have a little bit more red tape you got to jump through. There's less banking institutions that will lend once you're up over 4. And so the more loans that you hold in your name, I will say it gets a little bit harder and a little bit trickier, and requirements get a little bit more strict as you go down that process. So if you have a seller hold that note, it's going to keep that loan limit low with banking institutions. So that's just another thing to think about. Why should you use seller financing for the seller? They're able to earn monthly income each month through your payment to them. So for instance, we always think of this as a pro for potentially maybe older, retired people who own their home outright. They necessarily aren't looking for like a major payout, but this would just be nice residual income that they could be earning on a month-to-month basis to help, take over or replenish, let's say that they're recently retired, the monthly income that they were, used to get from their job, or this would just be added bonus to the monthly income that they still get through retirement. So that can be advantageous for the seller. Another thing that can be really great about it for the seller is that it can help the seller avoid paying a large tax bill on the sale of the home if you negotiate a lower payout to them. So if you, decide that you're going to maybe put down 50%, let's say, and then finance 50% of it, they're only going to have to pay tax on 50% that you put down, right? Instead of 100% that you would have to pay in cash, or if you were to go through a banking institution, they would get the full payment of that property. So let's say they were selling the property for $100,000 and you bought it through a bank, right? You're going to take out that loan and they're going to pay the sellers that $100,000 and then they have to pay tax on that. So with seller financing, you can negotiate terms that are beneficial for the seller that could be beneficial when it comes to taxes. So that's always something to think about whenever you approach somebody, a seller, about seller financing. You want to also tell them how it can be good for them, right? Yes, we know it can be great for you as a buyer, but how can it be great for them? And frame your conversation around the idea that it can be advantageous for them as well. Because that is really, I think, one of the things that we've learned throughout this process is, one, here's a tip. You need to always ask if they're interested in seller financing. You'll be shocked at the amount of people who won't even know what that is. I bet probably at least half, if not 75% of the times that we've asked if the seller is interested in seller financing, they have no idea what it is. So always, always, always ask. That's a tip that I have for you. So again, if that makes sense, give me a like, give me a heart, let me know that it is making sense. All right, last one that I'm going to cover tonight are partnerships. And partnerships, really the what. What is a partnership? Is when you find other individuals to go in on acquiring properties with you. This is a good strategy when you're just getting started because it helps diversify risk and down payment amounts. But I will say you don't have to, if you're somebody who owns a couple of properties and you're looking to scale or to grow, this is also a good strategy for you because I know it can be hard once you've kind of outlaid a lot of cash for those first initial properties. It can be hard to kind of build up that cash down payment again. And I can tell you, we didn't bring partners in till just, I think, maybe 2 years ago, we started working with some partners. And so we had owned, by that point, probably 7, 8 units before we ever brought partners in. So it isn't, something that I say you have to do in the beginning. I think you can do it at any point along the way where it makes sense for you. Why should you use partnerships? If you can't afford that hefty down payment in the beginning, it can help you fund the down payment so that you can buy a rental, right? It makes it possible. And when you're just getting started, that's what you want. You just want the possibility of this happening. So if you split that down payment, say you get a partner that comes in with you and you split that down payment, you're only having to save, half of that large sum amount. It also helps diversify the risk because you're not going out it alone. And that can give a lot of people peace of mind or be able to sleep better at night knowing that you're not in it all alone. You have somebody to talk it out with. You have somebody to problem solve with. That can go a long way when you're just getting started and you maybe don't know that much about investing in rental property. It can help to have kind of somebody on your team to kind of help navigate the trenches with you. Another thing, it allows you to bounce ideas off of each other. You can learn together. Or if you go into partnerships with somebody who's more experienced than you, then you are able to learn from them and they can kind of mentor you through the process. So there's, definitely a lot of pros to working with partners. Where to find partners? You'd be shocked. And I tell you, as the first thing that I think you should do is just start talking about what you want to do or what you are doing with investing. Just talk about it to people you know, to friends, to family, to colleagues. You'll be surprised at the people just within your own little network that may also be interested in investing too. And I know we found that out when we kind of started sharing with people what we were doing. We were really surprised at the amount of people who were interested in potentially partnering up and doing deals. So I say talk about it. Get out there and just talk about it. And you might be shocked to see who you already know. You don't have to go out and network at meetings. You don't have to get online. While those are all things that I think you can do down the road, I would simply start by just talking to people that you know, and seeing who might be interested. All right, all in all, again, these are only a few of the options out there for financing properties. And the truth is you have to find one that fits you in your current life situation. You know, where we were at the very beginning when we first started is very different from where we are now when it comes to what our life looks like, what our finances look like. So for everybody in every different type of life situation, there's going to be an avenue that will fit best for you, and you just have to figure out what that one is. If you want to learn more about financing options, and again, tonight I went over the what and the why. If you're looking to learn about how to go about this and actually see examples of this and numbers and deals, we're finishing up our brand new course, which is Financing Avenues for Buy and Hold Investors. It's going to be releasing in the next couple of weeks inside our pro community over at Rental Rookie. So if you're interested in learning more about that, again, we'll be covering the what, the why, the how, and examples of each financing strategy. We'll be covering at least 8 different financing options. So we'll be looking at hard money loans, cash out refinances, house hacking, partnerships, cash, conventional, IRAs. So it's definitely something that if you're looking to find a financing option that fits you, you're going to want to stay tuned for that when that comes out. If you want to learn more, head on over to rentalrookie.com/pro. That's where you can find out more about us here at Rental Rookie, find out more about our pro community, which is our membership community that has tons of resources, video training courses, videos, a community where you can learn and, you know, really be a part of a bigger picture whenever you're in your own investing journey. So if you're interested, head on over to rentalrookie.com/pro. If you have questions, if you're watching this later, not live, feel free to throw questions, comments, concerns in the comment section. I will be sure to get back to you. And again, thank you for taking some time to join me tonight on this live training. And until next time, happy investing.